Hey, what's up, everybody? Welcome back to Investing Sucks. So in this video, we're going to be doing an updated analysis of the company Nuvei. This is a TSX listed tech stock, and it's actually a company I covered on my channel about a year and a half ago. And one thing I've been doing over the past few months is revisiting some of the earlier videos that I made on this channel and doing an updated analysis to see what has changed and whether or not my thoughts on that company have changed. So in this video, we're going to be doing that for Nuvei. And I figured in the past year, or really since 2023 started, this company's actually been doing pretty well in terms of its stock price performance. As we can see here, since January 1st, it's up almost 70%. So I figured with a move like that, it's worth taking a deep dive into just seeing what's going on with this company and what has changed since the last video I did. Now, before we dive in, I kind of want to just give kind of my overall thoughts on the TSX tech sector as a whole, because it's one that is pretty unique in that it does seem to fluctuate quite a lot. So what I'm showing you here is this custom chart that I made. And by the way, if you're wondering what website is I'm using here, it's called tickernomics.com. I'll leave a link in the description of this video to the website if anyone wants to check it out. But one thing I did here was use the scripting feature to make a custom chart, and it's one that I've sort of jokingly called the TSX Delusion Indicator. So why am I calling it the Delusion Indicator? Well, as we can see, this kind of hit an all-time high towards the end of 2022, and then it has come down quite a lot since then, but now seems to be creeping up a little bit. So what this measures is the total price to sales ratio for all TSX listed tech stocks. So it sums up all the revenue for, the trailing 12 months revenue for any company that's in the technology sector that is listed on the Toronto Stock Exchange. It then sums up their market caps, and it divides market cap by revenue to get a kind of a total industry price to sales ratio. Now, why I've called it the delusion indicator is because despite these high valuations that have gotten more and more expensive as time has gone on, these haven't actually produced what you would consider a proportionately large amount of free cash flow. So in other words, these valuations haven't really proven to make sense. And this big correction that we've seen here does seem to be rather warranted, because if we look at, a true measure of business value, which for me, I like to look at free cash flow, this is the total industry free cash flow that's been generated by TSX tech stocks going all the way back to 2012. So the exact same companies that we were just looking at in terms of that industry-wide price to sales ratio, this is how much free cash flow they're generating in total. And we can see, it has trended upwards, right? Obviously, it's fluctuating quite a lot. And you can see there's a big spike here, probably because one company had a pretty good year, but it has trended up, but overall it hasn't been these sort of strong astronomical gains that you would expect to see with companies becoming so much more expensive in terms of their price to sales over this time period. And I wouldn't say this is a uniquely Canadian or TSX issue, but it does seem to me that there is it's definitely like a contingent of companies that are TSX listed tech stocks that got extremely expensive for no real solid reason and have since corrected quite a bit. And a few of these companies, Nuvei included, were hit by short seller reports, which is a big reason why we saw this tumbling down in the valuations. Lightspeed was another one, which is a company that I've covered a few times on my channel now. Short sellers, they can come at companies all they want, right? With whatever allegation, whatever they're saying is wrong with the company. I don't personally have a problem with short selling. I think it's generally a good thing that companies that are either unsuccessful or committing fraud or paying management excessive salaries, they do get punished for that if that is the case by these short sellers. But ultimately, a company can prove any short seller wrong if they actually end up being a successful business. So now let's jump into Nuvei and see if they're actually doing that. Now, for a quick background on Nuvei, they are a payment processing company whose key competitive advantage is their ability to process a wide variety of payments. So whether you're talking about different currencies, different payment methods, different devices that a customer is paying on, their platform is designed to essentially make it all seamless. And they've specifically designed their platform for what they refer to as high growth e-commerce. Because if you think about an e-commerce business, they're probably expanding into different regions, taking payment in all forms. They want to be able to make that whole process seamless. So that's what Nuvei helps with. And they do also have a pretty large exposure into cryptocurrency and online gaming, as we'll get into later. Now, one thing I like to do when it comes to tech companies, one of my favorite charts to look at is the price to sales ratio. And the reason I like this one specifically is because it kind of shows you how sentiment around this company has changed over time, because it shows you how investors are valuing $1 of sales for that company. And again, we see, it got very, very expensive in terms of price to sales. 27 was the peak here, which is extremely high. I mean, even for a high growth tech company, that's extremely high. And then it came down quite a bit. And it was kind of around this time here in the end of 2021 when they got hit with that short seller report. Some people called that, just fear mongering. Some people thought it was legitimate, but ultimately the impact on the valuation here, as we can see, has been lasting as they haven't really recovered to that same level yet. And it has been kind of on a downward trend. So, for a high growth tech company, I definitely think, a 5 or a 4 price to sales ratio seems more reasonable. Now, another metric I also like to look at is the EV to EBITDA. So this is actually looking at profitability, right? Because that's EBITDA. I mean, some people don't believe that's true profitability, but it is a good measure because you're stripping out the effects of, whatever their depreciation, amortization accounting policies are, whatever tax rate they're paying, whatever interest rate they have, and you're looking at kind of just the true earnings power of the business, taking out the things that they don't really have control over, right? So this is another valuation metric, and it's pretty much followed the exact same pattern. We can see it got very expensive here, corrected around that time here, and has since it's been creeping up a little bit. So it has been getting more expensive as of recently. We can see here, but overall follows the exact same pattern. Okay, so now let's dive into what actually drives this business to help us understand it a bit better. So help us understand what we need to monitor on this company on an ongoing basis and what we should look for to understand whether this company is doing well or if things are going bad. So since Nuvei is a payments company, obviously a key driver for their business will be total payments volume. So increasing their payments volume from existing customers and also acquiring new customers. And they talk about it here in their press release where they say total volume increased 34% in December 31st, 2022. So their most recent report, 127.7 billion from 2021 when it was about 96 billion. So this is obviously a key thing to monitor, and they do state that e-commerce represents 89% of their total volume. And to be honest, that's really it, right? That's all this company does. I mean, they have a small revenue that comes from selling hardware for their payment software, but ultimately the success of this company just boils down to customer acquisition, retention, and just facilitating more payments. So they do have an incentive to have customers that are in growing cohorts, like growing e-commerce businesses, because that means more transactions are passing through their platform. So I would say this company is very, very easy to understand in terms of its business model, right? If you look at its financial statements and try to understand, what's its revenue, what's its cost, the balance sheet, etc., it's pretty easy to do. Like you don't need to be an accounting expert to understand what's going on. But what makes this business, in my opinion, more complicated is understanding why customers would pick Nuvei over other options out there. And also, what are the other options, right? What's their competition? And we know this company has stated that their competitive advantage, right? It's the seamless nature of it and the versatility of the platform. But to me, unless you're an expert in the payment space and you understand what customers are looking for in terms of a payment processor and whether or not Nuvei actually meets that and how well they meet that and how well their competitors meet that and what's going to lead to someone picking Nuvei over a competitor, to me, it's really hard to build an accurate assessment of this company. Again, just because I personally don't have that background experience. And what makes it difficult further is this company really doesn't disclose very much. Now, the fact that their revenue has been growing, if we take a look at their financial statements here and we can look at the income statement, so we can look at it on a quarterly basis, but also on a yearly basis. Their revenue has been growing and they had very strong revenue growth from 20 into 21. That was almost 100% growth. So I think a lot of investors saw that and got really excited about the potential of this company. It has kind of flatlined a bit, and we'll get into, kind of the underlying details of these numbers and what it reveals about this company. One thing they do disclose, like I said, is 89% of their payment volume comes from e-commerce, and they describe their platform as purpose-built for high-growth e-commerce. Because again, e-commerce may have customers from around the world who will all have different payment methods, so this service helps them. And it's also important to note that they are actually profitable at their current run rate, which proves that they're not just growing their revenue by spending excessive amounts on, marketing and offering, purchase discounts or all these incentives to get customers to sign up for their platform. They're actually profitable and they're running a business that people are willing to pay for. So even though we don't know the specifics of their business and how the whole payment processing industry works, we can at least see that and say, okay, there's some tangible evidence there that they're doing something right And the fact that their revenue did grow quite strongly means that customers are clearly jumping onto their platform for some reason, and they see some benefit in it. Now, if we keep looking at their income statement here, one thing that stands out is how much their margins fluctuate by. So if we start by looking at the gross margin, this one doesn't really fluctuate that much. We can see pretty consistently it's kind of in the high 70s to low 80s range. But then when we look at the operating margin, this fluctuates much more. We can see going back to Q2 of 21, it was as high as 28%, but now it's come down pretty substantially. And even in Q3 of 22, it got below 5%. So to me, I see that and I'm immediately thinking, okay, what's going on here? Like, what's causing such rampant fluctuations in this company? And specifically, it's an issue here in Q3, right? So I went to their Q3 MD&A to see what I could find. And what we quickly learn is that it kind of highlights a very real risk for investing in this company, and that is foreign currency risk. So we talked about before about how this company, they accept payment in multiple currencies, multiple devices, multiple platforms, etc. And one of the key things with that is some of their revenue that they earn isn't going to be in US dollars or Canadian dollars. It's going to be in a whole wide range of currencies. And if those currencies weaken in relation to the US dollar, then you're going to see some losses in terms of they're not going to earn as much revenue as they otherwise could have. And this is highlighted here. So this is looking at the 9 months ended September 30th, 2022 compared to 2021. And they say, revenue overall increased, right, 22%. But revenue was impacted unfavorably by changes in foreign currency exchange rates by 28.3 million. Now, 28.3 million for a $600 million or 600 million revenue company, that's not nothing, right? I mean, you're talking about 6% of the company's revenue. That's something that you need to take into account, and that's real revenue that they've lost. And they also present this metric that they call revenue growth in constant currency, which is revenue excluding the impacts of things like foreign currency exchange, crypto fluctuations, etc. And if I'm an investor, I'm not even going to look at that metric, right? Because to me, those fluctuations are the cost of doing business for them, right? Your whole business model is predicated on you accepting payment in all these different currencies. That's what you advertise to your customers when you're trying to win them over. You have to deal with the downside of that, which is, it's going to fluctuate a lot. And especially if you're in the crypto space, you have to understand that that is a very real risk. So this is something that, it's not nothing, right? It's not the hugest thing that's going to completely break this company, but it's definitely something you need to understand if you're going to be invested in them for the long term. Now, that's not the only thing, right? Usually when you see margins fluctuating like this, it's going to be a multitude of reasons. It's not just going to be one thing. I mean, we looked at one thing that had about a $30 million impact, but there's something else that has an even bigger impact, and that is their employee stock compensation plan. So if we go here, this is their most recent full year financial statements, and what we're looking at is the statement of cash flows. And I want to show you the share-based payments here. So share-based payments is a non-cash expense that gets recognized related to stock options or stock grants that are given to employees. And this increased substantially here. We can see it increased from 53 million in 21 to almost 140 million in 22, right? So I see that and I'm thinking, okay, what's going on here? I mean, that didn't increase just because their headcount got so big. There must be something else that's going on here. And with these plans, these stock ownership plans, and especially in smaller companies, these can really be a silent killer because these can lead to a ton of new shares being issued for this company. And if you're an investor in that company, when they issue new shares, you now own less of the company, which means you own a smaller piece of their cash flow they generate, their earnings, etc. So I wanted to understand, okay, what's actually going on here? What should I know about this? And if we look at their disclosures here again, they talk about their share-based payments, and they talk about it a bit here, but they say one thing that stands out. So of the 33.8 million in share-based payments for the 3 months ended in September, so this is quarterly data, about 15 million related to awards with an exercise price or share price performance condition in excess of $100 a share. Now, you may be thinking that makes no sense. They're not even at $100 a share. If we look at their stock price here, they were at $100 a share, but they haven't been there for quite some time. And really, they're at $100 a share or a bit lower than that. They got hit with that short seller report around this time, and they haven't recovered to that since. So it's kind of confusing, right? It seems very odd to me that they would have this share-based payment And there's no condition included in that where if you hit $100 a share, but then you subsequently collapse, that that gets waived or something. They're still earning the share-based compensation, and it is pretty substantial, right? I mean, what management is doing here is they're enriching themselves, right? They're taking real money out of the company, or I guess shares from the company, and they can make a lot of money themselves doing this at the expense of the other shareholders. So seeing this, I was kind of wondering, okay, well, their shares outstanding must have increased a lot, right? And if we take a look at what that is, if we look at shares outstanding here, it hasn't. It's been going down actually, which is also an interesting part of the story. So how has it been going down if they have, down by, a decent amount here, if they've been, they must be issuing a ton of shares to their employees. And, that's a real expense of the business, right? It's not an expense that, is necessarily going to be, you're going to pay for with cash, but it's an expense that you're going to face as an owner of the business because employees are now owning more of it. So what exactly was going on here? And if we take a look at uh, their changes in equity statement, so I'll zoom in here a bit, we can see kind of how they're allocating capital. And this is for the 2022 year here. So they issued about 6 million shares this is related to their share-based payments, but then they bought back a ton of shares here. They bought back almost 76 million shares outstanding. And if we go back to the cash flow statement, we can see that's a significant part of how they're allocating the capital, right? I mentioned before this company's cash flow positive. They generated 267 million in cash from operations. Good for them. But how do they end up using that cash? Some of it went to acquiring intangible assets here. That was a big one. But a lot of it went to buying back shares. And when it comes to share buybacks, management needs to ensure that they're buying back shares at attractive prices and not at expensive prices. Now, whether or not you think Nuvei is expensive is obviously going to be subjective depending on, what your assumptions are for the future performance of this business. If they end up being the next Visa, then obviously management did a good thing in buying back these shares. But if the company ends up, not achieving their expectations, then they kind of wasted money, right? Wasted money on buying expensive shares that they really didn't need to. And in a way, it masks the effect of dilution, that the dilution as a result of their share-based plan, right? So there's different signals that you're getting here, right? It hides the impact on the shares, and buying back shares when your stock is expensive is not a good thing because, like I said, you're wasting money if you're overpaying for your stock specifically. But management doing this because they know that it can signal to investors that they think their stock might be undervalued. And if they also release very optimistic future guidance for their business in conjunction with buying back their shares, and maybe you also throw in some some insider purchases in that, investors are going to see that and think, okay, maybe this is a good investment because management's buying back the stock. The actual managers of the company are investing in it more. They're releasing this very optimistic guidance. That can be pretty convincing to a lot of investors, but those are all things that management can just do without actually having to prove it yet. Eventually they're going to have to prove it, but they can do that in the near term, raise their stock price, and then they hit that $100 target, then management's going to make a lot of money. So it's not something that I'm gonna, call them out for and say this is a terrible company because of that, but it's definitely something I would be concerned with and want to monitor if I'm an investor in this company. Okay, so if you made it this far, then congratulations. I hope I've at least enlightened you a little bit about this company. The last thing we're going to do is we're going to touch on the valuation. So the whole point of this exercise is to try and understand what sort of future performance expectations are built into this company at their current price. And then we can assess whether or not if we agree with that and if it makes sense and if we're willing to invest in those expectations. So with Nuvei, we are dealing with a rather expensive valuation of this company, even after their recent drop. They have a market cap in US dollars of just over $6 billion. And in the last 12 months, they've done about 225 million in free cash flow, which is about, a 26 or 27x multiple. But this company is free cash flow positive. So, and they've stated many times that high free cash flow generation is a key focus for them. And using the DCF method is probably the best course of action here. So the discounted cash flow method to value this company. So to do this, we're going to use the value a stock feature, which basically it calculates a discounted cash flow for a company and determines what the intrinsic value per share is given certain assumptions. And the whole point of this is just to kind of speed up the process of valuing companies so you don't have to worry about, the technical aspect of the DCF model, but it allows you to get, pretty customized in terms of what you want the model to look like. So again, this is on my website here called tickernomics.com. And we just type in, the ticker symbol of whatever company we want to value, and then all this data gets generated here. So this data here is based off of 5-year averages. We can leave it as is, or we can change it, which pretty much all the time I'm going to change it because I want to actually build into this valuation what my expectations for the future are, if I have any. And then down here is kind of, some other parts of the valuation that we'll leave for now. But it also calculates the cost of capital here. Now, the beta for this company is 0, and that's just because they don't have a 5-year history yet. So we are going to have to manually adjust the cost of capital or the discount rate, which I'll just make it 10%. Now let's look at these assumptions here. The tax rate, so this is obviously, it's been negative in the past, but it's obviously not going to be negative in the future. I'll just put it something standard, like say 22%. The operating margin, let's leave this as is for now, and let's leave the revenue growth as is for now, and let's also go out 7 years into the future, so a 7-year DCF analysis. And then the working capital for this company is basically negligible, so I'll just adjust this to 0. They really don't have that much working capital, and everything else I'll leave the same. I'll leave the same terminal value multiple here as well, and if we calculate the DCF, based on that, we're going to assume that the company is pretty undervalued at this price, right? An intrinsic value of 74 with a current price, again, in US dollars of just under 40. But if we look at what expectations are actually built in here, so we click on this details tab, we're basically assuming that by the year 2030, they're going to be doing $16 billion in revenue. That to me is way too high. And that's what happens when you're growing at 50%, revenue growth year over year. I mean, Visa, for example, is another payments company. They do, I believe, between 30 and 40 billion in revenue per year. But they're a $500 billion company, right? Nuvei is a $6 billion company. So we're not projecting this company to become half of Visa. That would be extremely optimistic and unreasonable. So we're going to have to lower this revenue growth. So let's just lower it to a point where, these two things here kind of collide, because then we understand what sort of expectations are built in. How much revenue do they need to hit? What sort of revenue targets do they need to hit for the valuation to make sense, right? And then obviously, if we're investing in them, we think that those revenue targets will be even higher in the future. Now, one thing we should also adjust here is the terminal value multiple. We looked before at the EV to EBITDA multiple, and we saw that it kind of got very high at one point, but currently it was kind of in the range of 20-25. It is going to gradually, depress over time as they realize some of that growth potential, and valuation multiples shrink in response to realized growth potential as businesses become more mature. But let's up this a little bit and let's put it at 15 for now. Again, the whole point of this is not to try and, pull up my crystal ball and predict the future. It's really to just understand what's currently priced in. And the revenue growth, let's do something more reasonable. Let's just do 20% revenue growth. And let's up the operating margin a little bit to say something like 15. We saw it got as high as, 25 in the future, and it did fluctuate substantially with, their share-based compensation, the foreign currency. So we're not going to have it at 25. Let's have it at 15. So we calculate the DCF based on that. Now our intrinsic value is lower, so the company's overvalued at this price. So, and if we look at what we're actually assuming in revenue, we're only assuming they're getting to 3 billion in revenue by 2030. So maybe you have higher expectations than that, right? Let's say they get to 25% revenue growth. What happens then? Now we're pretty close, right? And we can probably even go to something like 26% revenue growth. It'll be pretty much bang on. So we calculate that, and there we go. It's about converged there. So we can basically assume from this that this is what's priced into the company, right? So by the year 2030, about $4.2 billion in revenue at a 15% operating margin. Now, maybe their operating margin does better than that, right? And that wouldn't be unreasonable because this is a company that has operating leverage, right? And operating leverage, it's pretty common with tech companies. We saw their very high gross margins. So as they scale up their revenue, their costs as a percentage, like their fixed costs, like their, employee expenses, any selling general admin expenses, those as a percentage of their revenue get lower and lower and lower as the company earns more and more revenue, ideally, right? So maybe they average, say, a 17% operating margin. And that's going to increase, our intrinsic value estimate very substantially, right? By about $5 per share there. But it's still not really in that sweet spot. For me, I would want to assume with what I think are reasonable assumptions based on what I understand about the company, that the intrinsic value is at least double the current price. Then I have a margin of safety and I can think, okay, even if my expectations are incorrect, I could still be generally right about this company and still probably do okay in the long term, which I think you need to have that if you are investing in individual companies, because there's plenty of other risk-free options out there. You can invest in index funds. If you're going to go through the work of trying to identify companies to earn higher returns, then you should at least, project based on your assumptions that you will actually achieve those. But anyways, guys, that pretty much does it for me for this video. So again, I hope you did find this insightful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate if you would consider subscribing. And I'll see you guys in the next video.